What's going on, guys? Thanks for joining my channel, Robinhood. This is Bob. Today is July 29th. Today I'm going to answer a viewer's question, basically just giving you a detailed explanation on option trading. This comes from Yvonne B. Hi, Bob. Just subscribed to your channel. Wanted to ask, how did you learn about options? Seems a bit complicated to me. Any input would be highly appreciated. Thanks. For me, I learned basically how most people probably learn, just trial and error. Most people probably start with buying a call. It's a little less costly than selling a call or selling a put. So let's start with buying a call. Definition wise, basically you would pay an option premium in exchange the right to buy shares at a fixed strike price on or before a certain expiration date. So basically you believe the stock will go higher than the strike price, so you would be bullish. So we would pick an expiration date. The farther you go out, the higher the premium would be, but let's just pick August 7th. This is coming next week, Friday. So basically you're picking a $16 strike price. You would pay a premium of $48. So your main goal by the end of this date would be to hope that this share would go above $16.48. If it does, then you would break even and keep your premium. Anything higher, it would make you more in the money. Anything lower, then you would be out of your premium that you had to pay. The next one would be buying a put. We'll give you a definition on that. This gives you the right to sell a given stock at a certain price by a certain time. For that privilege, you pay a premium to the seller of that put, who assumes the downside risk and is obligated to buy the stock from you at a predetermined price. So basically you believe that the stock will go down, the strike price, so you would be bearish. So if you did buy a put, same expiration date, same strike price, you would pay a premium of $58, hoping by the end of close on the 7th that the price would be at $15.42 or lower. You would break even at $15.42. Anything lower than that, you would be more in the money. Anything higher, you'd be out of your premium. The next one would be selling a call. I prefer to sell a call or sell a put because you get paid a premium, but it does hold a lot. It holds 100 shares of whatever strike price that you would have, or you would have to have $100 shares of that amount of money of whatever strike price you pick. So we'll do sell a call first. The definition would be you receive a option premium in exchange for the right to sell shares. It would have to be 100 shares at a fixed strike price on or before a certain expiration date. So this basically means you believe the stock will go below the strike price, so you would be bearish. So if we did sell a call at $16 expiring on the 7th, you would get a premium of $48 and you would get a break-even price at $16.48. So as long as the shares at this price does not go above $16.48, you would basically break even, but you would have to have 100 shares of this already. So basically you're putting collateral of 100 shares. It doesn't matter what price you bought them for, just whatever strike prices means you'd have to sell them. So for an example, if the strike price was at 16 and it went to 16.50, you would have to sell 100 of your shares at $16, and breaking even, you would basically lose 2 cents times 100 would be $2 you'd be short of. But you still do get to keep this premium. So I like this option because you keep the premium and there's a higher percentage chance of profit that you get for this. The other option is if you don't want to have 100 shares of it, you can sell a put, which means If you sell a put, you receive the option premium in exchange for the right to buy shares, 100 shares, at a fixed strike price or on before the certain expiration date. So basically, you believe the stock will go higher than the strike price, so you would be bullish. So if you did sell a put, same expiration date on the 16th, then you would have a premium of $58, and you are hoping that the strike price will go up. So as long as this price goes to $16 or higher, then you would not be obligated to purchase 100 shares at $16. So this would put $1,600 on hold for you, but your break-even price would be $15.42. So anything $15.42 or higher, you would be in the money. So the reason I like to sell calls or sell puts is that they give you this percentage here. So basically, buying and selling are going to be opposite. So if you sell a put at $16, you get the premium of $58. Chance of profit is 62.43%. When you put buy, it doesn't give you the percentage of that, but it's the same premium you would have to pay. So it would be opposite of what the chance of profit. So if you pick a $16 strike price at 62% profit, the other end of buying it would give you a 38% profit since you're putting up a premium. That's the same thing for the call. When you do a call at this price, you get $48 at a 68% profit. The other end buying it would give you a 32% profit, which it doesn't give you the percentage. Yeah, so that's why I like to sell the calls, sell the puts. The other downfall of doing it this way, you're only guaranteed to make a profit of that amount. So if you are getting this premium price and it doesn't hit it, this is the most money that you can make off of this. If you buy a put or buy a call, you can make as much money. If the stock goes up to $50, you would make so much money off of that, but the chances of that happening is slim. So I do prefer on selling a call. I would just give you an option here because I actually did buy 100 shares of Jets. I have 101 shares of Jets, and I did do the option on Tuesday. I bought a strike price of $17, so I did sell a call. So I put 100 shares of Jets for a collateral to get a $10 premium. Right now, Jets is sitting at $15.89. The call price is at $17. My break-even price would be $17.17. So by this Friday, I highly doubt that it will hit the $17 range when I would have to sell all my shares for $17. So this basically would give me a $10 profit for the contract that I've had. Even though $10 may not seem like a lot of money, if I do this every week, that's $40. That's basically 2.5% interest that I would get for that particular move, which is 2.5 times more than average just keeping it in a savings. So this was a 82% at the time that I bought it. So I was pretty confident that this would not be executed, and it's basically just free money, and I can do that every week. That's the reason why I chose this particular one, because some options are every week, some options are every month, some are quarterly, so I can go back and forth with this. And if for some reason I did end up selling 100 shares, I would basically go back and then do a put and go on the opposite end of it to get a premium to buy it at a certain price to get more money. And if I did buy it, I would circle back around. So one other way that I decide on buying or selling options. So if we go to the 7th, so next week when I do get my shares back, I will check out both ways So there's two ways that I look to see which way I want to go. So if I sell a put expiring on the 7th, I really just look at the percentage of the percentage and the premium. So currently, if I do an 83%-ish profit, the average is $15. And if I go to the call, I go up to an 82%, it's a $20 call. So next week I probably would sell another call for $15, $20, whatever this one's sitting at the time, because the percentage is about the same, but the premium would be more. And the other way to look at it is if the stock is on a rise, selling a call, you will get higher premium for this. So if it's on a rise, I would get the higher premium, but maybe pick 1% up. And if it is on a decline, I would sell the put and then pick one below and get the premium for that. Most likely these premiums would just slide down one notch if it does go up a certain percentage. So I hope this video did help you guys. If you guys are have any other questions about other than option trading, definitely let me know. Please leave a like, leave a comment, subscribe, and I do have a link below as well that will get you a free stock if you are not signed up through Robinhood, and it will also get me one. Thank you guys again for watching.